In this session, we will look at the need and role of stock market indices and how equity markets are regulated. First, let's look at the stock market index. A stock market index comprises a statistically significant sample of equity stocks that represent that market and the price movements characteristic of the entire population of equity stocks traded in that market. Examples of stock market indices around the world include the Dow Jones Industrial Average, the NYSE Composite Index of New York, FTSE of London, Nikkei of Tokyo, etc. For a more exhaustive list of stock market indices that are tracked globally, please see the document link provided at the end of this video. By reviewing the movement in the index, investors are in a position to gauge the systemic movement in equity stock prices in the market with which that index is associated. Do bear in mind that price movements of individual stocks traded in the stock exchange could be more volatile or less volatile than the index itself because of firm-specific risks. However, the overall price movements across all stocks day to day would be well reflected by the stock market index associated with that exchange. Now let's look at how stock markets are regulated and why do they need to be regulated. Firms depend hugely on the equity stock market and the bond market to raise financial resources to meet their long-term capital needs. To achieve that goal, therefore, a high level of participation by investors in both the equity stock market and the bond markets is imperative. No investor would want to come to these markets unless they have full confidence that those markets are functioning effectively and transparently, and that the information available to them about the firms they are investing in are reliable, correct, complete, and hence can be trusted. Capital market regulators such as the Securities and Exchange Commission in the United States have a major role to play in monitoring the integrity of these markets and protect the investor's interest in the best possible manner. Regulators achieve this goal by ensuring a high level of disclosure by all the firms whose equity stocks are listed for trading in the exchange, thereby minimizing information asymmetry. Regulators are also empowered by law to bring to book any participant who willfully or otherwise engages in activities such as insider trading that could in any way undermine the efficient functioning of these markets.